CCC. First thing first, we should know what is cash conversion cycle. The cash conversion cycle is the length of time from the beginning of the production process to the point when cash is collected from the sale of finished product less the average payment period. It represents the amount of time the firm's resources are tied up. As we can see in CCC, there are three sections of period. First one is inventory conversion period, ICP. Second one is receivable collection period, RCP. And last one is payable deferral period, PDP. The lower the CCC is, the more better. Lower cash conversion cycle means that the company needs fewer days to recover money spent on materials. But for the company, it is not good because it takes 214 days. The company has to take 149 days to sell the inventory, that the company has to wait 120 days for receivable to be paid and take 55 days to pay its suppliers. When a company collects a receivable quickly, correctly forecasts inventory needs, or pay its bills slowly, it shortens the CCC. A shortened CCC means the company is more healthier, that the additional money can be used to make additional purchases or pay down outstanding debt. But there are a few ways to help the CCC of the company, which are by improving debt collection procedure, so as to collect cash outstanding faster but without pressuring customer, so that the sale will not be lost. And the second one is by settling account payable in the slowest possible way but without damaging the firm's credit rating. Next, we move to inventory control system. Inventory control system is used by businesses who need to keep track of various types of inventory. Inventory control system also used to identify the relevance of each stock item in terms of its annual consumption value, and is divided into three categories, which is A, B, and C. Category A have the highest value. Those in the B category have a lower value than A, and items in the C category have the lowest value.
Now we move to 2 bin inventory control. It used to determine when items or material used in production should be replenished. When the first bin items have passed out, an order is placed to refill or replace them. The second bin should then have enough products to survive until the first bin order arrives. Computerized inventory control system. It is a system where a computer is used to determine points and to adjust inventory balance. When withdrawals are made, they are recorded by the computer and the inventory balance is revised. The computer automatically places an order when a reorder point is reached, and when the order is received, the recorded balance is increased. As a result, whenever a purchase or a transaction is performed, the inventory system automatically adds and subtracts in inventory. Just-in-time system. It is an inventory control system in which a company coordinates production with suppliers so that raw material and components arrive at the exact time they are needed in the manufacturing process. Cooperation and excellent relationship between the firm and its suppliers are required for material to arrive on time. The JIT approach can be used by even some small merchants to streamline the delivery process. Outsourcing. Firms use the method to reduce the load of producing components of finished item in-house. As a result, rather of manufacturing internally, a system of purchasing products or components from outside vendors. Now, we move to concept of 5C of credit criteria. The first one is character. It is the most important aspect of the evaluation of credit worthiness. A company will look at the mortgage applicant's overall trustworthiness, personality, and credibility to determine the customer character. The purpose of this is to determine whether the applicant is responsible and likely to make on-time payments on the debts. To evaluate a customer character, company may look at an applicant's credit history and past interaction with firms. Likewise, they may consider the customer work experience, reference, credential, and overall reputation.
Next is capacity, which summarizes a customer ability to repay future debts in light of their existing obligation, where your cash flow is critical here, as is your debt-to-income ratio. Also, a business needs to know how much money a customer owes versus how much money he or she has. A bank will view your credit request more favorably if your debt-to-income ratio is modest. Other factors are how long to look about are the consumer has been at his or her current employment and how stable his or her income is. Next is capital. Capital is the total pool of asset owed in the customer's name is referred to as capital. Lenders want to see that you're dedicated enough to provide some of your own capital when asking for a business loan, mortgage, debts from a firm. Next is condition. Condition is evaluating a customer personal finances. Companies look at other financial conditions like the overall health of the economy and specifics of the debt. This typically includes the loan interest rate, principal amount, and intended use of the loan proceeds. However, the lenders also consider outside factors like the state of the economy as a whole, industry trends, and other conditions that might impact loan repayment. Next is collateral. Collateral is a valuable asset a customer pledges to secure a lender's interest in making the loan or debt. If the customer defaults on the loan or debt, the company can repossess or otherwise seize the asset to recoup the unpaid amount. A customer's ability and willingness to pledge valuable collateral reduce the risk to the lender. Now we move into management of current liabilities. There are three sources of short-term financing. The first one is trade credit, the second one is bank credit, and the last one is commercial paper.
Okay, the first one, trade credit. Trade credit is one of the traditional and common method of raising short-term capital. It is an arrangement in which the supplier allow the buyer to pay for goods and service at a later date in future. The objective of the firm would be to pay as slowly as possible without damaging its credit rating. By paying on the last day of the supplier credit terms, this will allow the maximum use of an interest-free loan from the supplier. Most suppliers would offer cash discount for yearly payment. Okay, next, bank credit, major sources of unsecured short-term credit which take the form of lines of credit, revolving credit agreements, and transaction loans with maturity period of 1 year or less. Rate of interest will depend on the creditworthiness and risk of the borrower, prevailing interest rate. A line of credit is an informal agreement between the bank and the borrower in relation to the maximum amount of credit provided at any one time. Okay, the last one is commercial paper. This is a form of short-term financing consisting of unsecured promissory notes issued only by firms with high credit standing, usually large firms that are financially sound. The interest charge is lower, 0.5% to 4% as compared to commercial banks. The pros and cons of the above sources of short-term financing. The first one is the pros of trade credit. First, easily and readily availability because no legal formality are involved. Next, trade credit is a flexible source of working capital. Whenever necessary, the buyer can delay payment because the seller normally accept the generous request. The concerned can earn cash discount by making payment before the expiry of the credit period. The cost of trade credit. First, the cost of trade credit may be very higher. Next, availability of liberal trade credit facility may induce a concern to overtrending which can be harmful. The pros of bank credit. First, generally a cheaper method of raising working capital. Next, flexible because banks offer different schemes of financing working capital and commercial banks serve as a friend, philosophers, and guide to their client in respect of the most appropriate method of financing and utilization of credit. So next, the cons of bank credit. The first one is in order to raise funds from commercial banks, several documents have to be submitted and signed. It is a time-consuming and expensive process. Next, commercial banks generally take a serious view of delay in repayment and interest. The pros of commercial paper. The first one, the interest rate is generally lower compared to bank loans and other sources of short-term financing.
The issuance of commercial paper does not require any compensating balance requirement. The form of commercial paper, two commercial paper provide cheaper short-term financing, either by pledging the account or by factoring them. The pledging account receivable under this agreement, the borrower pledges account receivable as collateral for a loan obtained for each individual account pledges. This loan charges interest about 2% to 5% higher than banks, with even higher interest being charged by finance companies.